All right, great. I'm going to keep this pretty short. We're standing in your guys' way of cocktails, and I'm looking forward to a cocktail and some Portland beer. I'm Wes Selke. I'm the managing director, one of the co-founders of Better Ventures. We are based down in the Bay Area in Oakland, California, and we're coming to this conversation really from the private angle. I manage a venture capital fund. We back technology companies that are solving social and environmental problems in the world with business models that really scale. So we're really big believers in the role of technology and its ability to really solve both social and environmental problems in the world. And we sort of investing across a few different themes where technology is closing the opportunity gap for individuals by empowering individuals to improve their livelihoods. Things like education technology, financial inclusion, as well as work opportunity. Secondly, we're looking for opportunities where technology is improving access to healthcare and lowering the cost of healthcare, of high quality, affordable healthcare. And thirdly is our sustainability bucket, which is really around sort of information technology services and the role they're playing to transition us from a fossil fueled economy to a clean powered economy. And we've made a number of investments. We're on to our second fund now across all three of those categories I just mentioned. For example, we're about to announce a new investment in a very interesting education technology company that's based in Oakland, which is really preparing underrepresented groups for jobs in the technology sector by combining sort of the best of online and offline technologies sort of in the educational space. And another company worth mentioning, another company based in Oakland is called BrightCurrent, which is sort of enabling solar companies to more quickly and more cost effectively acquire customers for residential solar through the retail sector. So, and this whole kind of conversation around, are you leaving money on the table with investing for impact? We believe that, you can not only, make just as good a return through impact investing, but that, we have a kind of a whole thesis around how we think you can actually outperform the market by investing in these kinds of companies. These are really big market opportunities: education, healthcare, sustainability. There's big opportunity in those markets. We're backing entrepreneurs that have that intrinsic motivation to solve these problems, not just to make a lot of money and get rich, but actually solve these big problems. And thirdly, the ability for these companies to really cultivate more brand identity and attract and retain top talent. So we believe investing in this category is something of a sort of competitive advantage over some traditional products that are out there. And we're really starting to prove that through the results in our first fund, which has been operating for about 4 years, and we've generated an IRR of 38% in that first fund, and that fund has tripled in value just in the last 4 years. And we're about to close our second fund. We're raising a $20 million seed fund, and I've made 5 investments, going on 6 in that fund, and looking forward to connecting with all over cocktails. Thanks.
Sure. So, as you can see, I'm Kevin Lehman. I am a research analyst, a fixed income research analyst. So my forte is in like 300-page PDFs. So if my 4-minute concise popcorn pitch doesn't go over too well, that's the reason why. I work at Breckenridge Capital. We manage $23 billion in exclusively investment-grade fixed income separate accounts. We started formally offering ESG strategies about 4 or 5 years ago. And so since then, we've gone from $0 under management, and we just crossed over the $1 billion mark. I mentioned that, 1, just to toot our own horn, but 2, to give kind of a concrete number to the growth that all the other speakers have alluded to today, that it really has been impressive over the past 2 years in particular, the interest that has been going into our strategies. And a huge part of that has been medium and small foundations and endowments. So I'd say, total assets of $5 to $100 million have been, from our perspective, the most nimble and willing to really dive into ESG strategies. So You're going to hear a lot of good, quick pitches about other asset classes. I think the way that we approach ESG, I think it makes the most sense for fixed income. There's not a whole lot of fanfare for fixed income, probably because yields are at 2% in the 10-year. But it's an incredibly important asset class when you think about ESG being long-term, sustainable type risks. So we buy bonds that mature anywhere out to 15 years right now in our Hallmark strategy. And we want to be comfortable owning those bonds through their entire life cycle. So our turnover in our portfolio is about 25%. So we have to be comfortable buying these companies for the long term. Just a couple things in terms of the nuts and bolts of what we actually do. So we're buying corporate bonds, and we're evaluating them just as part of our research process. ESG, for us, is an integration into our research. So we have 14 analysts on our desk. Every single one of those analysts for the companies and the sectors they cover has a holistic approach, and we have a formal framework that's quantitative and qualitative to assess different ESG issues for each sector. One example I would use to kind of touch on two things that we do at Breckenridge. Negative screening is a big thing in the industry. We've built out systems to be able to customize portfolios. So I cover the energy sector. We have several dozen accounts that are fossil fuel free. We feel very confident about our way to structure a portfolio and accommodate those types of screens. So that's one thing that we can do for our client, but that's not necessarily what we're excited about going forward. Relating the issue of fossil fuels and energy to ESG integration, one thing that our current positioning is to be underweight long mature energy bonds. So that's kind of the discrepancy between the two different things that we offer at Breckenridge, the customization piece as well as the integration. And I think I'm out of time, so that is me and Breckenridge, and I will also be around drinking with the rest of these guys.
Thank you. Thank you. I feel very powerful right now.
All right, so I actually have slides. So David Miller, Clean Energy Venture Fund. We are an early stage venture fund focused on clean energy companies. And I'm going to make an assertion here that one can improve returns by investing in clean energy. And I'm not going to say much about the public markets. I don't know the public markets, but I can say there is a tremendous opportunity to improve returns investing in early stage clean energy startups. So if we look at the industry, clean energy is a huge industry. We know that. We've talked about it. Compared to other industries that are large. So this is an industry growing by trillions of dollars. And in an industry that's growing by trillions of dollars, there are lots of opportunities for companies that can go from nothing to hundreds of millions of dollars. Again, creating a massive opportunity. But there's a problem. And universities are somewhat at the crux of this problem. There's good news and bad news. Good news is there's tons of research being done that can help solve climate change. That research is involving in patents, and there are very motivated, very talented entrepreneurs looking to commercialize those technologies that can really solve significant problems with respect to the climate. All great news. Problem is no one is funding those technologies. No one is funding the commercialization of those technologies. So what's going on? Well, there are some great investors, some great funds, but there's a structural issue of why they can't address this. Because if you have a venture fund and you're managing several $100 million, it just doesn't make sense for you to be making $500,000 investments into seed stage companies. It doesn't work. You're not going to be, if you do that, you're not going to be able to manage that portfolio because you have to make way too many of them. And so what the larger venture funds did when they went into clean energy and wanted to allocate capital is they ended up allocating capital to very highly capital-intensive plays, manufacturing and so forth, which weren't necessarily an energy play. It was a manufacturing play. And that didn't work out for venture funds. That type of strategy didn't work out. So what kind of strategy will work out? Well, a focus on the seed stage and a focus on clean energy. And focusing by being able to be very hands-on across a large seed stage portfolio. and having a reasonably sized fund, so actually a small fund, and having a set of partners who have the experience and expertise to be hands-on across the portfolio. So my partner and I have 14 other partners who've been working with for 10 years, developing this group, making these investments, focused entirely on seed stage clean energy. And it works, or at least our performance shows that it works. So again, my partner and I, investing together over the last 6 years, have returned a 28% annualized return. Most of that is unrealized. It's valuing the companies at the last time other investors have put in money. The realized return is 60%, and we believe the portfolio is going to come out in the mid-40s. One of the questions you might have is, well, if no other investors are investing at the seed stage, where do these companies get additional capital? Well, once we invest, for every dollar we've invested, other investors have put in $50. And those are across 50 institutional investors. So there's tons of capital at the later stage. It's really that crucial gap between early stage commercialization and growth. So I'll end with 2 points. Number one, we need to fund early stage clean energy companies that are commercializing the solutions to climate change coming out of universities. Those companies need to be funded to address climate change. Number two, those companies are exactly the companies that present the best investment opportunities. Thank you very much, and happy to talk later.
Hi, everybody. I'm Rob Schultz. I'm one of the founding partners of Green Tech Capital Advisors. I'll be brief. So we are a firm 100% focused on sustainability. We're an investment bank and an asset manager. We founded our company in 2008, and right now we've got 45 people in 3 locations. We're in San Francisco, we're in New York, and we're in Zurich. On the investment banking side, we've completed $8 billion of M&A transactions, and we've raised $3 billion of capital for our clients. Interesting enough, I didn't realize this until literally 30 seconds ago, but we were the banker for the Great Point Energy deal that Dave Miller's partner did when we sold it to the Chinese investor. It was the largest clean technology transaction between U.S. and China ever in our sector. So we did that deal, so that was pretty exciting. Fast forward to today, we now have a public equities business. We have a long, short, and long only fund focused on what we call stable infrastructure. It's not a traditional wind and solar fund. It's really an industrials-focused fund that's focused on sustainability. So for example, we'll invest in A.O. Smith, which is a most efficient water heater. We'll invest in Acuity, which does lighting systems. That's kind of the folks we are. Some investors will say, well, why are you a long short fund when you're focused on sustainability? And our view is that green has to be green. So there are losers in our sector that have to be eliminated, and there's also winners. We're trying to create 2 new products, and one of the new products really is a private equity fund that we're going to create. We've been in China for the last 3-4 months, and we're very close to signing a term sheet for a $300 million private equity fund that's focused on sustainability. It's a traditional 2 and 20 fund, you know, with an 8-year plan. That's one thing. The other thing we're going to do, which we're really excited about, is creating what we call a long duration fund. And a lot of the schools here and universities, endowments, and you saw the presentation before, are getting a 2 or 3% return on their fixed income product. We believe that if you buy contracted assets, for example, you invest in a project where there's solar or wind project, where the developer creates it, it's a 20 to 25-year program, there's an offtake agreement where a Walmart or a Google or a Bloomberg buys that energy, you can get a 6 or 7% return. We think it's a low-risk product. We think it's great for large endowments. So that's kind of the third product we're going to do. So really to sort of, you know, wrap up the whole thing, you know, we're a firm that wants to do whatever we can to get capital to our sector. We think that's the most important part of our sector. We think there's too many firms or companies that need capital, and we think this is a great time to do it. So we encourage everyone here to invest with any possible kind of firm that's going to put more capital into our sector. So we think, as Dave told me about 15 minutes ago also, I'm going to make too many plugs here, but he told me the biggest transition right now is the transition to a clean energy economy, and we think that's the way the world's going. All right? Thanks very much.
Hello. Thank you very much. Thanks to the organizers. This is great. You're hearing a little bit about clean energy. That's important, I guess. Kendall Sustainable Infrastructure is the name of my firm. We were recently selected by Impact Assets 50, which is an annual thing that they put out, selecting the top private fund managers in an industry. So we invest in projects that sell electricity, make regular cash flows, and we distribute the cash. We get really great returns doing that. It's not correlated to the market, and it's not very volatile. And that happens to be 100% green. There's a lot of low-hanging fruit out there for folks that are thinking about how to invest. And Kendall Sustainable Infrastructure, the way we do it, puts us into a niche market where there are a lot of folks in there, CalPERS, CalSTRS, TIAA, Kraft, MetLife, Berkshire Hathaway. These major names are all doing similar things to what we do. We're just in the distributed generation market, which is an underfunded market, but it has almost as many deals in the solar space. So we're able to get some outstanding returns. I want to make 3 points. Number one, there's a profound shift, and it's great. This is a profound, simple business model. Think about this. Zero commodity input, zero emissions, and you sell an invaluable commodity at the outside. Imagine you were in the sweater business, and you had to buy yarn every year to feed your factory to make sweaters. Somebody said, I could build you a factory tomorrow. You never have to buy yarn again. You get to sell sweaters on the back end. Who wouldn't do that? That's what owning renewable projects is. I want to tell you, it's not a boutique industry anymore, okay? $250 billion is expended on new renewable projects every single year. To put that into context, when I started about 10 years ago, the amount of renewable energy in the U.S. was equal to about 20 coal power plants. Today, the amount of renewable energy is equal to 180 coal power plants. There's 570 coal power plants left in the U.S. I guess I'm not going to get to this too much, but I'll do the best I can. This is sort of a value chain of investing in renewables, and you've got everything on the left to the right. There are many ways to invest in renewables, so I want you to walk away. I'll talk about my fund, but there are lots of different ways. We're project owners. These different facets of renewable energy, each one has its own attributes. It has its own risks and returns. Everything from component supplier, manufacturers, developers. They're not the same, and it's important when people talk about renewable energy, investing in renewable energy, to really differentiate and dig down and say, how am I investing? And to truly understand it. This is one other chart. This is private renewable ownership on the left-hand side. It's a steady cash yield annuity. On the right-hand side are a bunch of yieldcos plotted against the S&P 500. Yieldcos do, in theory, they try to mimic, they own renewable assets, and they try to get a consistent yield out of it. Unfortunately, because they're publicly listed, they're correlated to the market. And you can see those two circles represent just the market fell, and they fell. And then the second in the middle there is the oil shocks. Oil shocks should have almost nothing to do with the price of renewable electricity, because oil is really related to the transportation energy, whereas renewables are electricity. So for all those reasons, it's important to understand when you do invest, renewables are a great investment, but there are many variables to look into and to really get familiar with. Thank you.
It's a delight to be here. My name is Patrick Drum. I'm portfolio manager at Saturna Capital. Saturna Capital has been involved in integrating what would be best put today as what we consider environmental social governance attributes for well over about 3 decades. I kind of often joke we are in the most upper northwestern quadrant of the United States, in a little town called Bellingham. And it's more of our firm has been known by its equity work with the signature funds, the amount of growth and the amount of income, which may resonate with you. We're about 20 miles south of the Canadian border. I joined the firm a little over a year ago. I've been involved in integrating fixed income, or rather fixed income in itself for about 20 years, integrating ESG attributes for the last 10. I also teach as an adjunct prof at one of the colleges up in the Seattle area, as well as leading the United Nations Principles for Responsibility on the fixed income outreach. That is educating other professionals as really the more important questions of why you should care, what does it mean, and how is it being applied. I run the Global Sustainable Bond Fund. It's the very first one of its kind because it's a part of the space where really trying to create a added degree of diversification. I think an important attribute is, what does our term internally mean as responsible investing? And to me, being a creditor, and I've been working on several white papers that are being published, as well as the work that we've been doing. But it really is, from a bondholder's perspective, we don't have the capacity to be an advocate or shareholder engagement through voting. So as a bondholder, we have to think very differently defensively about risks. And I'm being the one who is the bondholder looking to preserve my client's assets and preservation of capital. I'm thinking of how companies are forming a competitive position to retain resiliency. Let me use one example, and it's not to be indicative of the entire portfolio, but sometimes context helps. So I'm an owner of Southwest Airlines, and I'm sure we all know who they are. But through their one report, they've indicated a clear profit through the three aspects of people, profit, and planet. They have clear goals of having 0 environmental fines, of which they've been successful 2 of the last 5 years. Last year was 5,500 or something of that nature. 41 years of consecutive improved profitability, and they pay their employees above average wages in the industry. I don't see how added due diligence and looking at material risk is considered a concern. And so I'm thinking about how to preserve capital. Now, again, I'm applying this on a global side. One of the things I do is also provide education. Having been in this role for a while, I have papers on really what I call the sustainability smile. It's to help kind of have that conversation with your board and your colleagues as to what all this means. And the sustainability smile, sort of in simple terms, is on the one far side is that you're looking at the most conservative or conventional finance, and you're saying, mail me the styrofoam cup. I don't care about anything else, but give me the returns. And then you're going to have on the other side the ones that are philanthropic. All I care about is just optimizing the greater good. I don't care about returns. Somewhere in that smile, working as we are a faith-based organization, though the sustainable funds are not, is faith-based or advocacy, where some of it may be thematic here, where you're hearing some of our discussion on water, energy, and so forth. I'm on responsible investing, or where we're looking at material, environmental, social, and governance risks to drive performance, informed competitive advantage. I'd be happy we have that piece. You can simply go to our website or reach out to me, but it's a pleasure to be here. And more importantly, I continue to look forward to have these conversations. Thank you.
Getting worried one of you guys is going to hyperventilate. Could you please breathe a little more?
Thanks, everybody. I'm really glad to be here. My name's Charles Sandmel. I'm an investment manager with Shelton Capital Management. We're a boutique firm in San Francisco. We run about $1.25 billion, and I am part of the green growing edge of that firm, which is about $150 million. Most of my work is in separate accounts in fixed income, and of that, because of the nature of my clients, most of that is municipals. And I do a fair amount of work in taxable bonds. I've been working with bonds and public finance since the 1970s, first as an issuer, then as a bond analyst, then as a guarantor, then as a portfolio manager. And somewhere around 25 years ago, I got the idea that I wanted to integrate my work in fixed income with my passion for responsible investing. And the short answer is it took me 20 years to become an overnight success. The area in which I am the most interested is green bonds. And the definition of green bonds are bonds that finance, clean energy, clean water, mass transit, energy-efficient buildings, and open space. And they can be issued by corporations, municipalities, government agencies, supranationals, just about anybody. And again, the definition is the use of proceeds. Now, this gets you into some really interesting questions. How green is it? Now, picture in one hand an endive, and picture in the other hand a handful of a bunch of spinach. They're both green. This one is a whole lot greener than that one. Did anybody read the article in the Wall Street Journal earlier this year about the green parking garage at Salem State University in Massachusetts? Kevin did, yeah. Bond-funded project for the university system in a college which has no mass transit access. They had a parking field where the water ran off and everything else. They needed more parking. So they decided to build a greener parking garage. It is built from sustainable products. It has low voltage lighting. It has, I believe, a solar array on the roof. It has charging stations for electric vehicles, bike parking, and a bus interface. Now, from my point of view, that's green. It certainly is greener than the alternative. These are the kind of things that you need to think about when you're doing your investing. There's about $100 billion of this stuff outstanding, and it's being issued in all rating categories and all sections of the yield curve, from the short to the long. A good manager will dive deep into these. If you have questions about it, ask your bond manager. There are 3 of us here, and if your bond manager isn't interested, ask your bond manager why he or she isn't. Thank you all very much. I look forward to continuing this conversation, and I won't let you make the funny noise.
Oh, you're gonna have to click a little bit to get past Charlie's slides. They're doing it for you.
Yeah, they're up
Maybe
there.
right up there.
The clicker's up there. Oh, the clicker's up there, okay. Yeah.
Excuse me. Hi there, everybody. It's great to be here. Thank you, Barbara and George, for making this happen. I think the discussions are off to a great start, and later on this evening, I'll look forward to speaking with some of you later on this evening and also tomorrow. So I suppose whether you're here as representing an asset owner, investment manager, consultant, advisor, trustee, or student, maybe it's fair to say that the common thread that is running through each of our discussions is perhaps the pursuit of financial performance accompanied by economic, environmental, or social impact. And so I work for a company, South Pole Group, and we are all about measuring and reducing climate impact. And so with that, as they say, as the guy on NPR says, let's do the numbers. 10, the number of years that South Pole Carbon has been in existence, headquartered in Zurich. 128, the number of carbon emissions reductions projects that our company has developed, financed, and administers, mostly concentrated in developing, emerging, and frontier markets around the world. 1,000, the number of companies, governments, and environmental agencies for whom South Pole Group has reduced their carbon footprint. 55 million, that is cubic metric tons of carbon emissions that our company has saved over a 10-year period. And just to put that in a little bit of context, the country of Portugal has annual emissions of 55 million tons of carbon a year. Some of the other numbers here, 20,000 jobs created through our projects that are concentrated around the world, and which brings us to our work in the investor community. We have screened $650 billion worth of investment portfolios. South Pole Group entered the capital markets about 5 years ago, principally through a grant from the Swiss government, which enabled the company to work with the Swiss Institute of Technology to build the world's largest greenhouse gas database for publicly traded companies. And so we are out there in the marketplace providing our greenhouse gas emissions data and our portfolio carbon screening tools. So if you're an asset owner, investment manager out there, and you'd like to measure the climate impact of your portfolio to get an understanding of your carbon intensity, your exposure to different dimensions of carbon asset risk management, we invite you to look at our tools. And in this regard, we're very closely aligned with some of the principal institutional investor initiatives that are out there, one being the United Nations PRI's UN Montreal Carbon Pledge. Perhaps some of you in this room know a lot about that. And also the Portfolio Decarbonization Coalition, which is principally led by the CDP. So thanks again to the organizers, and I look forward to the opportunity of speaking with you sometime soon. Thank you.
Mark, bring us home.
How's everyone doing? We're almost at drinks. Contrary to everyone else, I do not want to talk to you during drinks. Just stay as far away from me as possible. I should also mention, it's great to be the last person here. It's an exciting sort of round robin here. I'm happy to provide a much needed diversity. The panel is a slightly younger white male. So with that, want to talk about 4 programs of ours. I run the Sustainable Endowments Institute. I'm founder of the organization. We're a special product of Rockefeller Philanthropy Advisors, based in Boston. We've been around for 10 years. And we run a couple of programs that many of your institutions are already part of, and we've got 2 programs that are newer that I'd love to tell you about that are entering pilot phases. The first one is the $1 Billion Green Challenge. About $120 million is committed to this program. It's a model whereby institutions sign on to create their own self-managed green revolving funds to invest in energy efficiency and conservation projects on your own campus. A whole bunch of institutions are part of that. Caltech, CSU Fullerton, Lane Community College, UCLA, Portland State, Arizona State, Harvard, and 50-plus other institutions. More information on that's at greenbillion.org. And I think it's a really fascinating model to help connect the dots between your endowment and your on-campus activities related to efficiency and conservation, either as a complement to your other investments or as a new frontier. Another program of ours is called GRITS, which stands for the Green Revolving Investment Tracking System. And through some support from the Kresge Foundation and some other funders, we built over the last few years a web platform that makes it really easy and simple to track and manage all your project data, from lighting upgrades and heating and cooling upgrades. Over 225 institutions are using GRITS right now all across the country to track several thousand projects, 1,300 of them, which is available through a GRITS library. And if your institution is part of APA, which is an association of facilities managers across the country, you actually get free access to GRITS through that. So if you want to know more about that, you can check in with me later. We're really excited about that because it does all the financial calculations, including the internal rate of return, net present value calculations. And interestingly enough, of all the institutions that are using GRITS and the 1,300 plus projects that are in there, the median annual return on investment of those projects is about 18%. So very compelling. These are institutions doing their own internal projects. On to the other side of the picture with a couple of slides here. Number one is we're building a pilot for something called the BEST Fund, which just tentatively stands for Building Energy Savings Together. And so this is interesting for institutions that may not have resources to do efficiency projects, that are interested in accessing capital to do that, or those that have capital but want to help deploy it to more under-resourced nonprofits. So very simply, the BEST Fund basically helps set up revolving funds at under-resourced nonprofits. And we can go into this more later, but the basic idea is you are taking capital, deploying in helping do efficiency projects at under-resourced nonprofits, and you get this sort of multiplier effect wherein an initial $10 million investment that we'll be looking to launch next year, hopefully, turns into about $350 million in lifetime energy savings, and some pretty big numbers in terms of carbon savings as well. So happy to talk about that more later. Don't have time for the go-to-market plan, but basically we'll be launching a pilot in the first quarter of next year. We'll be going from there to a full fund expected later next year. The simple idea is basically helping institutions that can't do these projects otherwise get access to capital. And then the very last thing I'll mention about, which is we've been talking about shareholder engagement, is we earlier this year acquired another nonprofit called Proxy Democracy that basically makes it very easy to analyze and understand your proxy voting record at your institution. Right now it's online, proxydemocracy.org, and has voting data from several hundred major mutual funds. So you can look up mutual funds if you're invested in those, as well as many large state pension funds and some of the sustainable and responsible investment funds that are actually here in the room, including Calvert and Pax and a number of others. That tool, we're looking at doing a pilot where we would actually invite a handful of universities and maybe a handful of foundations to share their voting records with us to allow you to do the analysis and actually see what your voting record actually looks like. So with that, we'd love to wrap up, and I will not be talking to any of you later over drinks. So thanks for your time.